Welcome back to All Things Money. I'm David Blain. In this segment, we're going to wrap up looking at our outlook for the global bull market. We'll try to get to some of our viewers' email, but this is a very important topic, and we'll just kind of go with it and see how much time we have left. But we're talking about why we don't feel like the global bull market is quite over. We look for some choppiness ahead, a lot of ups and downs, but we're not expecting a double dip recession anytime soon. If you missed the first couple of segments, be sure to visit us on the web at www.dlblain.com. That's DLBLAIN.com, and you can listen to archives of the show. So before the break, we were talking about how certain countries around the world are in what we call global bull markets and some in global bear markets. The global bear markets are your typical Western developed economies, the U.S., Germany, France, Italy, places like that. Your global bull markets are taking place in your Asian countries and your resource-based countries such as Australia, Canada, China, India, places like that. And we feel that the growth in some of these developing countries is going to keep the global economy moving forward somewhat in a positive direction, despite the relative stagnation in the more developed countries. GDP growth, 74% of the countries have positive GDP growth. In the emerging and frontiers economies of Asia, 100% of the countries are posting year-over-year positive growth, where in Europe it's 60%, Latin America 90%, based on the last available data. So we see that GDP year-over-year growth in these emerging and resource-based countries is 100%. The highest ranking secular bear country in terms of GDP growth is Germany at number 23 out of all the countries that we track. So not very high. Behind that, 25 is the U.S. at 3.2%. Where you look at Singapore, GDP year-over-year change is about 18.7%. Taiwan about 13%. In the negative category, countries like Greece and Spain. Unemployment rate, this is very interesting, especially you hear a lot of headline in the U.S. about unemployment. So there are many countries that have unemployment rate below the 8.5% of the OECD countries. Of course, 4 of those are in secular bulls. Canada, Mexico, Australia, and South Korea all have unemployment rates that are below the average. The U.S., France, and Italy are among the countries that have above average unemployment rates and higher than they were a year ago. It's interesting to note that no country in a secular bull market has unemployment higher than it was a year ago. So when we hear about these headline numbers of unemployment in the U.S., it's certainly a very dismal statistic that we hate to hear. But when it comes time to invest, we encourage you to look around the world. There are countries that their unemployment rates are dropping and that are rebounding much faster than the United States. Consumer confidence. Brazil is another country where they're secular bull with an improving unemployment rate, and the consumer confidence picture is especially upbeat in countries like Brazil, Australia, and China, where it's very subdued in places like the UK and France. So we look at things like consumer confidence. And in the country, it's almost like a self-fulfilling prophecy. In the countries that have high consumer confidence, their economy is growing, and so that pushes the economy further. When you have low consumer confidence, it keeps the economy down, and it makes it that much more difficult to break out of the recession. Housing. Among the 28 housing markets we track, the year-over-year price change is rising in 20 of them. The 4 biggest year-over-year increases are found in secular bull economies: Singapore, Hong Kong, Australia, and Taiwan. where you see house prices increasing. This is also a sign of a robust economy when you see that housing prices are increasing. The secular bears either have negative house price momentum, such as in Italy, or increases of less than 5%. We look at the global share of the world stock market, and we see compared to 2003, going back about 7 years, the secular bears, such as the U.S. and France, Germany, encompassed about 80% of the world market cap. Today, they only encompass about 68%, where your secular bulls have increased from 8.5% to 19%. Since the bottoming in October of 2008, 9 of the 11 secular bulls have gained more than 20%, excuse me, per annum, both in real, after inflation, as well as nominal returns. And so, as we look at this recovery from the global bear market, the global recession, these countries that are in secular bull markets, once again, let me highlight them: China, Canada, Brazil, Australia, South Korea, Taiwan, India, Russia, Hong Kong, Singapore, and Mexico. As we look at these countries, they're having tremendous growth coming out of this recession. So in summary, the global liquidity continues to flow away from the secular bear countries such as the U.S. and developed Europe and into the secular bull markets. And as long as these secular bull expansions remain healthy, we would not expect a return of a global recession. Well, we have only about a minute left, so we're not going to get to our viewers' email for today's show. So let me just briefly recap what we talked about. We think that the global bull market, although not going up in all countries and all around the world, we think that the risk of a double-dip recession is very low. We think the risk of deflation is very low. Looking at the markets themselves, the majority are in uptrends. Earnings are in uptrends. Commodities, which have been correlating with equities, are also in uptrends. Consumer prices are on the rise, mostly around the world. Business confidence is on the rise around the world. Our purchasing manager indexes, which are an indicator of wholesale prices, are on the rise. And, of course, the economic indicators themselves are on the rise. So we would encourage you to look outside the United States for your stock market investing. That's all the time we have for this show. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.